Morning, everybody. I'm going to let the panelists introduce themselves. Maybe John, starting with you.
Okay, I'm John Meyer. I trained as a mining engineer, did a bit of work in South Africa and the UK, and then moved into the financial side of things, doing project finance with Montague Mining Finance many years ago, moving on through Goldman Sachs, doing strategy, and then back into mining analysis at SocGen, Numis, and now SP Angel.
Hi everyone, my name is Heidi Sternberg. I'm a geologist for training. I've worked in the mining industry for, well over 20 years as a mining analyst for some local banks, and I'm now currently in the research team at the PRC.
Andrew Trahar. I'm with Vision Blue Resources, which is a mining private equity fund, and we invest in minerals required for the clean energy transition. So minerals that go into solar panels, batteries, wind turbines, magnets, motors, microchips.
My background is also from the industry. I spent about 25 years in and around the industry, first in the sector for about 15 years in copper, gold, coal. And for the last 10 years in advisory, first with Investec, and I now look after the resources advisory team at RMB. So maybe if we can kick it off, I mean, if we look at the region, and it's quite a big focus for us at RMB. I mean, what opportunities, what are the commodities that we see regionally? Because I mean, the transition metals is obviously a big focus area in the sector. But when we look at SADC and regionally, what are the opportunities that we're seeing as topical? Maybe, John, if we can start with you.
Look, you're right to mention copper, gold to start with, because those are the key metals. Those are the metals the investors understand. Those are the metals the industry is quite good at. When I think of the SADC region, I also think of uranium in Namibia, maybe even the DRC. I think of manganese. We think of rare earths, but we don't see many opportunities for it, but they're clearly critical and very important, but much more challenging for investors. And yeah, just about every metal these days is critical in one form or another. We see gallium and germanium, for example, in certain deposits in Botswana. So we see a lot of different bits and pieces around the place, but really, I think from an investor perspective, copper and gold is the focus.
Maybe to touch something on what you said, I mean, everything is critical, but Andrew, I mean, with your focus on more transition minerals, I mean, what we found in some of the processing situations we've been involved in, that the disconnect in volatility in the underlying commodity relative to market caps in that sector, and then these big project valuations that's being trying to be unlocked. I mean, I think quite simply is just how do you deal with that disconnect? And I mean, and on top of that, there's this competition in terms of the technology arena. You know, which metals are going to win the race, I suppose. So how do you deal with, I suppose, some of that disconnect in the market?
Do you mean disconnect in valuation versus opportunity?
Yeah.
I mean, I think it's very difficult. We have listed and private positions. In certain instances, it's actually better to be private and not be suffering the massive withdrawal from some of the stocks that we've seen. But of course, that also presents challenges because your universe of investors to tap for capital also is more challenging. So pros and cons of both. I think that large CapEx projects are really going to suffer in their ability to raise finance in this kind of environment, no matter how good they are from an IRR perspective. I think ideally you want to be circa sub $600-700 million of CapEx to have a prospect of getting financed in this environment. Of course, there are some projects that are very important, unique, that large players will want to campaign. But as a junior, thinking about the sort of audience that we're talking to here today, as a junior, you really want to be working out whether you've got the ability to deliver a staged development project You want to be able to demonstrate that you've got the upside potential of an expansion phase. You want to be able to show that you've got a financeable project. You've got to work very hard on getting your indicative debt packages together so you can show your investors that the net equity check is a financeable solution. Ideally, you want to work very hard on getting a good quality cornerstone in and then build your equity raise from there. Of course, that's all well and good when you've got a sort of project that's going into sort of construction ready phase. But I think it's extremely challenging right now to close the gap between valuation that you've got in your presentation as a result of the study work that you've done and actually putting together a viable, financeable prospect for your next phase of work. And I think what we really need is we need governments to step up in those kinds of regions to provide all the support that they can to show support for the projects from the soft perspective in terms of permitting, initiatives to implement infrastructure builds that will reduce the overall CapEx burden and help these projects get through the next phase of financing and ultimately to a construction decision.
Yeah, and I think that's tricky when you're at a conference like this. It feels like there's a lot of the projects, specifically on the critical minerals side, where, a similar conversation in the previous years, being stuck in that, let's call it pre-study phase and trying to raise the capital to actually take that to the next step.
I just add that I think that when it comes to some of the minerals that we look at, if you compare them to the bulks that were predominantly financed as a result of China's massive infrastructure spend, the bulks are typically lower value commodities, right? And so they do need bigger CapEx to benefit from economies of scale to make them work at their lower values. Whereas a lot of the critical minerals are much higher value products that can be put on trucks, even planes in certain instances. And there is the potential to generally build them in smaller incremental stages. Okay, maybe your stage one is not as high IRR, but if you can de-risk it, get it proven up, get it into production, you can then demonstrate full value for your massive phase 2 expansion and then get proper value from bigger investors who come in and finance the bigger check. So I think there is a big opportunity in the critical mineral space with commodities that are trading at thousands of dollars a ton to actually build smaller stage one operations, de-risk, and then look at the big expansion phase later.
Thanks, that's good insight. Heidi, from the PIC's perspective, how important is the sector in your portfolio? And do you find there's sufficient inventory of opportunity, I suppose, in the region for you to invest in as a PIC?
Yeah, so the PIC is very big on the listed side. From a mining perspective, the mining portfolio makes up a significant part of the PIC's overall equity portfolio. And that's driven mostly from investment in companies listed on the JSE. Unfortunately, that's where our primary focus is. And we've seen not a lot of new companies listing on the JSE, and that's one of our biggest concerns, is that the pool not only of mining companies but companies as a whole on the JSE is getting smaller and smaller. We're already significant minority shareholders on a number or most of the companies listed on the JSE. So we would love to see more companies listing on the JSE, especially companies that are operating in South Africa. I think the last time I counted, there must be about 15 companies working in South Africa on the mining side that are not listed on the JSE. And it would be great to have these companies listed so that we could expand our investment into all of these different companies, as well as other companies, not just mining companies. So yes, absolutely, mining is very big in our portfolio just because it forms a significant part of the JSE as a whole. From the unlisted side, we would definitely look at mining companies that are coming, but as Andrew said, that there's a big gap between your exploration side and getting it through the bankable feasibility stage, getting your debt investors online so that the equity investors can then come on and feel comfortable in investing in these projects. And this is where we're seeing a big gap in South Africa. We're not seeing a lot of those kind of projects coming to the fore. A lot of them are just too early stage. And this is where we think that IDC and the DMRE's very small but not insignificant fund will definitely help to bring those projects up the value curve so that equity investors like the PRC could possibly play once they've been de-risked.
Yeah, I think one of, and maybe just to unpack the inventory of opportunity a little bit further. I mean, we haven't really seen large-scale exploration regionally, but further up north in Africa. And I suppose one of the nuances is that a lot of this exploration are not done by the majors at the moment, but it's done in the mid-tier sector. You know, and that's a sector that doesn't have big balance sheets to drive large-scale exploration opportunities. How has that affected the potential opportunities in the area? Maybe, John, if you want to weigh in.
Well, if I can tie that in with what we've just been talking about, getting companies onto market requires, you know, support from regulators and government. And the regime in South Africa has just not been that helpful for many, many years. The huge economic empowerment criteria have put off investors for a long, long time. South Africa itself has always been a big company market, you know, ever since it was run by the majors. And still they're very important. But they're not what they were, certainly. And yeah, I think South Africa has missed out on on huge growth in the junior sector that we saw in Australia, Canada, and the UK. And yeah, you do need these entrepreneurial guys, particularly geologists. Somehow, when they're out on their own in the field, they seem to come up with a bit more. Maybe it's just because there's more of them doing it, but they have more motivation. When we talk to the geologists in the big mining houses, and this is a bit of a gross generalization, you get a job in a big company, you tend to want to reduce your risk. You don't want to lose the job. Whereas when you're an independent geologist out there in the field, you really need to find something. You will take lots of risk, and you don't have to go necessarily through all the health and safety either. So it's a very different mentality, and that mentality does seem to create results. And this is what the big companies need to pick up on. We do now see more coming out of the majors, particularly Rios and BHP, where they are looking around to see what everybody's doing and where they're being successful. And they are they're going earlier and earlier stage in what they're looking at, which is very nice to see. Because from an economic perspective, for a government to create a series of mid-tier mining companies is going to be very rewarding because they pay a lot of tax. And I mean, if you use examples, First Quantum, Lundin Mining, you know, these sorts of companies, when they get going, they grow fast, and and then they can be the next set of majors going forwards, because the world needs more and more of these big companies. You can't just have 3 or 4 major mining companies running commodities of the world. It doesn't. They're too conservative to go out there and feed the transition that we see for electric vehicles, the electrification of society. You know, Rios, Anglos, BHP, they haven't filled that gap. Yes, there's some major companies coming in out of China these days, but this is an industry which has been very Western-led for many, many years, and we have the expertise to do it. Okay, China, I think, has taken has gained the lead in metallurgical engineering, although a lot of that was here in South Africa for a long time. You know, if you wanted process engineering, good metallurgists, you came to South Africa for it. If you look at the Johannesburg area, an incredible amount of engineering expertise relating to the mining industry, which you don't find anywhere. I don't see it anywhere else.
Thanks for that, John. Maybe, I mean, we've spoken, and the words come up quite a lot on the regulatory risk, and I mean, let's talk about the elephant in the room. I mean, Andrew, maybe from your perspective, I mean, how do you, well, first of all, do you see differential risk between Africa as a jurisdiction or as a region for investment relative to other continents? And how do you deal with that? I mean, I think the mining sector is very unique in the sense that if you're in the retail sector, you can put up a retail business in any country. Yeah, you need to go where the minerals and the commodities are. So you do need to deal with this risk. And how do you approach that from a investment committee and credit perspective?
Look, I think the risk is something that we talk about all the time in our team. And I think what we really don't like to do is put the whole of Africa into one box. That's one thing that we sort of fight very hard to ensure people do not do, because it's just not fair. Africa is not one country. Africa is every country is different. Every country has a different risk profile. And we often like to make an example of, for example, Australia, where, Australia isn't a risk-free jurisdiction. Getting your permits in Australia is extremely difficult. In Australia, there have been numerous instances of the tax regime being changed unilaterally without engagement with the industry. Now, of course, Australia benefits from a lot of other fantastic low-risk qualities, abundant skill sets, etc. But you cannot just put the whole of Africa in one box. Even America, until now, potentially, very challenging on the permitting side. Canada, very challenging on the permitting side. Africa has a massive opportunity to be a supplier of a number of critical resources to the world. And I don't just mean critical metals. I mean resources that are very keen for the next phase of growth in the world's economy. And we think that every African country is different. We think some African countries that are perceived to be of a higher risk nature are actually very prospective, with very engaged governments, ministries that are very supportive of permitting regimes, encouraging good business practice in the nation, being sensible about the requirements of the miner. And I think that we feel that many African countries are very misunderstood as fantastic jurisdictions to go and build a mining business.
I think you touched on a good point. I mean, what we often see with boards is that there's preconceived ideas about Africa as a whole and specific countries. I mean, as you rightly pointed out, Africa is not one set of rules. It's 54 set of rules, and they're very different. And it does feel like different participants in the market are dealing with those risks in the various jurisdictions. I mean, even some of the jurisdictions that I think traditionally has been viewed very difficult to repatriate cash, it does seem to look like there's players that understand the risks and can deal and mitigate that.
And I think that just to add that, while I say that there are lots of African countries that are fantastic jurisdictions that are misunderstood, there are many African countries that could do a lot better, that have fantastic resources in the ground, make it very difficult for business to be done there. And I think that one risk, just aside from permitting, but a risk associated with nearly every mining project is infrastructure risk. And what we really need is African nations to build infrastructure, improve roads, reduce waiting times for trucks crossing borders, improve efficiency at ports, whether they're inland or marine port facilities, build big ports, build railway lines. That is what is going to facilitate mining projects being able to bolt on and actually connect to that infrastructure and export to market.
Yeah, I think that's all very valid. I think that the other dimension is obviously the stability and regulation. I mean, maybe Unathi, welcome, maybe to put you on the spot a little bit, but, in terms of this, if you look at the jurisdiction and some of the geopolitical issues that we've seen more recently in let's call it the mining relevant countries in Africa, I mean, how do you deal with the risk of that's almost, I mean, we talk about Mali, for instance, and what's happened there, but what we're seeing from investors, that neighborhood at the moment, people are suddenly putting another lens on it. How fair is that? And I mean, how do you deal with that type of risk when you look at investments?
Yeah, sure. I think it is very difficult. Obviously, as investors, we want stability, right? When a company is going to be investing in a country, they're very welcome to put the infrastructure on the ground to spend their money, but you often have issues trying to get the capital out. And for us as investors, that's really quite important. And I think some of the issues that you raised, like we're seeing in Mali, are obviously forcing us as investors again to put another lens when we're looking at investments. So when some of the major companies announced entering new jurisdictions in Northern Africa, the big questions that we're focusing on is, well, how sure are you that the situation there has really turned and stabilized? So I think for us as investors, it's about obviously building a diversified portfolio. So we're not looking for any one country, major country exposure or any one commodity exposure, because the reality in mining is that you can't avoid some of these jurisdictions because the endowments are where the endowments are. So how can we make sure that we are, diversifying that risk by making sure we've got different bets or different opportunities that we're taking advantage of? But I do think that mining companies themselves can manage those risks a bit better in terms of if they are good corporate citizens, if they are sort of delivering on some of the social obligations or some of the promises that they've made into those regions. That does help in some instances when you do get regime change. Then obviously it does give them a level of protection. So I think for us as investors, it is quite tricky, but we've seen examples like, Argentina, for example, South America was untouchable, and now it's back in being an investment jurisdiction because they have made changes or promises to make changes. And because of the scarcity of the resources, people are willing to invest in that. So I think as long as there's enough runway, that if you invest the capital, there will be stability and that the rule of law will be applied and your rights will be protected. Investors can diversify that risk, hopefully.
Yeah, I think it's interesting. It feels like, and I think, Andrew, you touched on it, that as a continent, we often score a few own goals, and that just unfortunately puts the brakes on, and in some cases actually reverse some of the good work that's been done. And it's trying to find that balance where, that these governments understand that there's a balance between getting a return for, and whether that's taxes and royalties or equity investments. And I think that's quite an interesting one that we're seeing as well, is that, should governments be equity investors in projects, or should they enable the development of these projects so that they can earn taxes and royalties?
Yeah, I was at an interesting conversation just yesterday with a mining company that's investing in a new jurisdiction. And the key thing that they were saying was obviously the lack of transparency on the government take. So some countries, it looks like they're taking 20%, others are taking 50%. And obviously, if there was transparency around that, if there was a bit more uniformity around that, for the mining companies, it doesn't really matter in what form it is, whether it's royalties or taxes or whatever it is, as long as it's fair and it's transparent and it's known. So I think there is an element where there has to be partnership. Obviously, if you are giving 50% of your take to the government, I think as we've alluded to, then that money should be going to infrastructure. That money should be going towards, helping those communities to diversify their income streams and the like. So definitely, I think collaboration is required between the mining houses as well as governments to make sure that those revenues are being shared equitably by the communities who are being affected by it.
With the elections in the US and some of the noises coming out of President Trump in terms of, and again, painting Africa as Africa rather than specific jurisdictions. And maybe Heidi, if you've got a perspective on this, is this one of those factors that may actually start breaking some of the momentum again, or is this something that's too far removed and maybe the impact's not direct? And maybe Heidi, if you can kick us off, and if the other panelists have got a view on that.
I think I missed your question, Willie.
Sorry?
Can we try the question again?
No, what I'm saying is with President Trump and the focus on tariffs and restricting African part, and he throws them in that box. Do we think that's going to stifle investment in the region? Are people going to sit back and say, let's first see what happens in the US and if there's real tariffs on African countries? Or is that something that, I suppose investors will just ignore and still look at projects in Africa?
Yeah, I think it's an interesting one. I think there's a lot of noise around at the moment, and we are just going to have to, as a mining industry, carry on doing what we've always been doing and work through the noise. I don't think that there's going to be significant pullback on investment in Africa. I think, what the world is seeing is that Africa is one of the most underexplored areas and continents globally, and there's this massive need for additional commodities and mines to be built. And I think that will probably carry on as it has been historically. I think one of the key things that the African region or SADC should be looking at is, somebody was saying it this morning, we as single countries, as the 54 different countries in Africa, we're not big enough to be a market driver on our own. But, if we look at it as a group, for instance, we could be a market driver, and hopefully there can be significantly more collaboration amongst the African countries and certainly amongst SADC countries to be able to see if that we can be the demand driver within ourselves instead of depending on exporting to the US.
I would just jump in and say for a second that, I don't think that there's going to be a significant change versus where we are already today. Investors have already pulled back massively, and that is predominantly driven by the uncertainty coming out of all of these elections over the last year, not just in the US, but particularly because of the US and the massive uncertainty around the direction of travel of the US economy under Trump. So there has already been a massive pullback, and we've seen that. I think that there will be potentially some instability even from some of the traditional Asian investors. But I do think that China will actually see this as an opportunity where Western investors are sitting on their hands. They can now step back in, having pulled back themselves for a while. And I think that they will start grabbing assets a lot more meaningfully. Don't forget that China is still the biggest consumer of most of these commodities. So it's actually not just a US story. China is still the major customer, particularly when it comes to some of the minerals like lithium, for example, where, you look at the EV minerals, China is by far and away the biggest consumer of all of those minerals today and are expected to be an even bigger consumer going forward because they are not fossil fuel endowed. They do not have the ability to sit on a fossil fuel strategy like the US does and can you continue to drive internal combustion engine vehicles for the next 100 years. China has made a decision to disconnect from reliance on third-party suppliers themselves, and that is a key driver of their EV strategy. And I think that they'll be more acquisitive going forward on particularly the likes of the EV metals and minerals that go into solar panels and wind turbines, etc., all part of their energy independence initiative.
I think you're right, though, because China has never liked the idea of importing anything from anyone. They want to be as self-sufficient as possible, and all the time they're putting in forwards initiatives for that. But going back to the question on Trump, there are a number of different ways of looking at it. I think first he creates opportunities. He's already been highly critical of new legislation in South Africa about expropriation without compensation. And as he's more and more critical about what smaller governments are doing, he's going to use American muscle, and I think there's no other way of putting it, to try and affect change such that it creates more opportunities. Not just opportunities for American companies, but actually for everybody else. So hopefully that will start to push back the opportunities for China. I mean, China has been amazing at stepping into Africa, developing infrastructure, but the cost of developing that infrastructure has been punitive. If you look at the way they've done that and the enormous cost that those countries are now having to repay, it's very dangerous. It's causing countries to put up royalties and taxes and stuff like that. And that needs to, shall we say, be reset in certain ways, particularly with, China was spending the money within their own companies. The Africans weren't building the roads. It was the Chinese companies doing it, for example. So there's that side of looking at it. Trump, I think, is also going to, he's a big driver of growth, but who's going to supply that growth? But China is very uncertain at the moment. Are the Americans going to be the big market for their products? And so they are having to take a slightly more cautious approach to everything. So we may see them carry on pulling back a bit more. And that's another opportunity for Westerners to come in and step into that breach.
Yeah, and I think if I can also add to that, I think I'd agree with that, is that the reality is that sanity will have to prevail. At the end of the day, the ambitions are to continue around decarbonization, electrification. I mean, that is a mega trend, even though ESG might now seem like it's slightly waning, but the reality is that everything is being electrified. And that means that all the critical minerals that are found in Africa will be necessary, even for the US. And so I think that, whatever threats that he might be putting in place now will be short-lived because exploration is taking place, putting our people money in exploring in Botswana, they're exploring in Namibia, they're looking for opportunities for base metals, which are going to be critical for the future. And you can't undo that. You can't reverse that trend. And so I think that, the imperative to secure those critical minerals might override some of the sort of short-term political shenanigans that we're seeing now, because those minerals are just vital.
I think the interesting thing that we've also been seeing in a few processes now is this disconnect between how Western, especially listed companies, are looking at valuations of some of these assets and the strategic premium that a Chinese investor or state-owned investor can put on these things. Something like the valuation of inferred resources, for instance, where for a listed company, if you do that, you face an impairment. But if you're a state-owned entity and you can pay up for what you would term, I suppose, obvious value, but it just feels like the scales, it's quite unbalanced in terms of the way that the investment decisions and especially the valuation decisions are made. I mean, how do you navigate that as a to try and still be competitive and actually unlock some of these opportunities? Andrew, I'm not sure if you and any of the panelists want to.
I mean, personally, I think that when it comes to valuations expected to be paid by acquirers, I still think that the Chinese may, in many instances, land up being the highest bidder. And we've seen that in a number of instances where the Chinese have the ability to bring the golden thread through their entire supply chain and consider a transaction on the basis that they may not care whether they make any money out of the mine because they've secured themselves resource to feed the entire supply chain right through to the end product. And if the commodity price goes up, okay, they'll make more money at the mine. If that then impairs their ability to make more money out of the downstream good, they don't mind because net they're still making money. They have that ability to look through the whole supply chain and take a long-term strategic view. And we're missing that in the West. We don't have those strategic actors. Some of the OEMs recently tried, and I think that most of them have really struggled to be able to act that way. They're responding to short-term shareholders, investors who actually don't want them to go out and take long-term strategic bets on a 10 to 20-year plan. And I really struggle to imagine how in the Western world, with such a short-term mentality, we'll be able to compete with that. And so I think that Chinese bidders in particular will have a significant ability to pay above the price that a Western bidder is likely to pay, commodity dependent, of course. In certain instances, maybe it's iron ore, maybe a major iron ore producer in the West is willing to get a lock on something to make sure it doesn't fall into the hands of a competitor, or, for example, wants to look at blending product. I mean, we haven't even touched on resource depletion. I think that that's going to be a major theme going forward in the next sort of 5 to 10 years because we've been eating into commodities at a massive rate. And we're going to start discovering that grades are declining massively, impurities are going up, and there are going to be majors who are going to have to start buying assets again to actually avoid the quality depletion levels and the asset depletion levels that we're going to see over the next 5 to 10 years starting to come to the fore.
Yeah, and maybe Unathi from your perspective, John, and even Heidi from a PIC's perspective. I mean, and if you think about these challenges, I mean, yet we need to secure some of these investments. I mean, how do we navigate this risk? I mean, it just doesn't feel that there's an obvious solution.
Yeah, so I think agreement valuations is obviously a big starting point. We do scrutinize companies or investee companies in terms of the transactions that they're doing. What are they paying for it? Is it value destructive or not? And obviously that's not going to change. But I think really, the opportunity here is for those companies to realize that if irrational investors or investors are willing to pay an exorbitant amount, there are risks that those projects don't come to fruition, which obviously does mean that you might end up actually with whatever we're thinking, with what we've put in our models as supply that's coming through from new mines, actually not materializing. Because, if commodity prices are lower, then they're overpaid, et cetera, then those don't become viable. So there is that in terms of the balance between all the projects, the land grab that we're seeing, and what actually does become built and comes onto the market that one needs to be mindful of. And so I think for me, it really is quite important that the companies we invested in continue to be disciplined in terms of capital allocation. Obviously, I think the majors, having burnt themselves in the past, probably haven't spent enough on exploration, and you have seen a change in that. Where there are a lot more JVs that are being announced, where the guys are willing to go a lot lower down in terms of actually doing the long-term thinking and putting money towards exploration with a longer-term mindset, which obviously is more valuable for an investor rather than just doing M&A and buying up things just because it's in vogue. And that's the price you're going to be forced to pay for it. So I think for us, it's about how disciplined is management in the capital allocation strategy? How aligned are they in terms of their incentives and the long term? And are they really thinking about how they're transforming their portfolios so that in 2050, these companies are still viable and still giving decent returns?
So I think there's quite a well-trodden path in terms of valuing assets at different stages of their development. But of course, what changes through the cycle is the availability of capital and the cost of that capital. And one of the things about Trump being in the White House is the cost of capital is going to stay higher for longer because the Federal Reserve is so worried about inflation in the US that they simply don't want to cut rates at the rate that they wanted to do 6 months ago. So, we have that. And that means that if there's less capital in the world, then there are less bidders and there's simply just less cash available for these sorts of higher risk ventures. The Chinese have got lower interest rates. They have to maintain higher rates than they probably want to because of the Federal Reserve. They don't want to see there's not so much of a carry trade out of China, but of course the money always flows one way or another. In fact, the Japanese are raising interest rates now, and that's something we have to keep an eye on. And yes, the Chinese do have this way of seeing through into assets. They say, well, okay, we want that underlying commodity, therefore we'll pay more for it. And there's in every era, there's always another group that is looking to outbid somebody else for various different reasons. And we should be concerned in the West that China is controlling more than probably it should do, particularly when politically they suddenly start flexing their muscles and saying, well, we're going to stop exporting this to the West. If you actually look at the details of what's going on in China, the politicians say these things, but partly it's because they secure the underlying assets to meet their own growth needs. And when let's if we use lithium as an example, when that spodumene goes into China and is converted, that's really intended for their own industry. And of course, they tend to sell that product anyway. Whatever the politicians say, they'll tend to sell that product to local guys. The guys they have lunch and dinner with, the guys who speak the same language. There's no need for them to export that product abroad. So as their electric vehicle industry grows, we should expect less and less of those commodities to be available outside China, whatever the politicians say. So the West needs to be very conscious of it, and people like Elon Musk I think is also cognizant of the fact that he needs to secure his own supply chain. He's hedging his bet slightly because he's also in China as well. But a lot of this political rhetoric we see, yes, it's saber rattling, and we should be very concerned about it. But it's not just politics; it's actually just what drives industry, and what drives industry is people doing business with the guys that they know.
Maybe a last one for you, Heidi. In terms of you mentioned the investment pool for the PIC are being, there's not a lot of opportunity at the moment. How would the PIC deal with that? Is it about going broader geographically in the region? Because, what we have seen is the tendency for explorers and developers not to be listed on the JSE because they can't attract the capital to actually do that. So, how do you see that risk and how do you mitigate the risk like that to ensure that you still get, I suppose, the benefit and the yield from the sector?
So, absolutely, it is a concern that there are not that many new projects happening in South Africa. And I think from a PRC's perspective, the country as a whole, South Africa as a whole, is something that we need to think about, and where our children and our grandchildren are going to be, growing up and living, and therefore South Africa is always at the center of a lot of the decisions that we make. So absolutely, we would love to see more projects, not only mining projects, but projects in beneficiation and across the value chain as a whole. To be able to invest in. I think one of the key things that South Africa should really think about, because there is just such a dearth of in exploration capex going into the country, is looking at what did Canada do and what did Australia do to be able to attract these investors, and that comes down to tax incentives, it comes down to flow-through shares, it comes down to allowing retail investors to be more flexible with their pension funds, perhaps, to be able to invest small pockets of money into these mining companies directly. I think there is definitely a need, not only from the PRC's perspective, but South Africa as a whole, to be able to do and be more flexible in those areas.
Thank you. Just to wrap up, maybe Unathi, starting with you, maybe a few closing remarks, just in the context of, I think where I'm getting to after this conversation is pretty much, it is difficult. But it's not necessarily more difficult, to Andrew's point, than some of the other more difficult jurisdictions around the world. I think you need to understand the different dynamics and nuances for each jurisdiction, because they're not one pool of opportunities. But maybe just a few closing remarks in terms of the future of this, the region for investment from a mining perspective.
Yeah, thanks. Yeah, so I think, the SADC region there's lots of exciting opportunities. You are seeing a lot of things happening just north of our borders, in the Botswanas and the Namibias, and obviously, as you've alluded to, Heidi, maybe South Africa not so much on the exploration side of things. But I think, obviously, given the long history that we've had within mining and the stability that we've had within mining, there's a lot more that can be done with what we have. In terms of life extension projects that people could be doing, the opportunities in manganese that we could be doing more, sort of M&A that could come through. There's a lot more around chrome that we could be doing, even in your sort of more mature industries, being gold and as well as PGMs. There's a lot more that the industry could be doing in terms of investing towards efficiencies, towards lowering the cost of production, towards making sure that they can withstand, the vagaries of the cycle, which is commodities. So I think, as an industry, there are plenty of opportunities to do more at home. We don't have to be looking for M&A opportunities in difficult or less understood jurisdictions. We just need to see the confidence and the commitment that there will be offtake for the products that we have. And that's an opportunity even for, the more mature commodities in precious metals as well. So I think I'm quite excited. I think, mining has continued to be a big part of our index that we're investing in. And it does change from time to time. 1 minute is iron ore, that's the top, now it's gold, and that will obviously drive, where the focus is in the market. But I think longer term, in my mind, nothing has changed. It's all still being focused on being part of the decarbonization value chain, as well as the electrification and, as well as the ongoing urbanization that we're seeing. Those are the mega trends, and our companies in South Africa also have an opportunity to participate in base metal exploration and growth.
John?
Well, when we look at the SADC region, Namibia, Botswana, Zambia, and Malawi look good. They're much easier to finance than Mozambique, Madagascar, South Africa. So South Africa, which has so much of the engineering expertise, so much of the mining history, really wants to be serious about developing more of its industry and creating new majors in future years. It needs to get a grip, and it needs to start looking at how at the taxes and the punitive issues that we have around mining here, and fix it.
Heidi?
I think that SADC as a whole is really quite exciting from a transition metals perspective and electrification perspective. Those metals, if we look at the region as a whole, we almost have all of them. South Africa itself doesn't have all of them, but we've got a lot of them, and I think that we certainly should play to our strengths. We've got a lot of gold projects that could potentially be extended. We saw Harmony extending Mponeng and adding 20 years life before the gold price rallied. So, there are opportunities if you take into account new technologies and things like that. And also, we've seen DRD Gold going in and looking at cleaning up their waste dumps on the West Rand, which will go a long way to, unlocking value from a land perspective and also from an environmental perspective. So I think there's still lots that can be done in South Africa. And SADC as a whole, we should maybe be thinking about doing things from a regional perspective to look through the value chain.
I'd say that, things change. They change constantly. Touching on the same comment, every commodity has its time in the sun, right? No one wanted to touch gold a few years ago. Gold's now pumping. Other commodities not doing as well. I think for the juniors in the room, concentrate on survival through the down times, because your time will come again. And, the commodities that aren't doing so well, lithium, significantly off. Everyone was on rocket fuel with lithium a few years ago, but now it's, more difficult. But stick with it, because the assets that have been built, are going to only form a portion of the supply chain. Demand is still growing for many of these commodities. If you've got a good quality asset, get into survival mode and stick it out, because your time will come. I think just a quick comment on South Africa. As a South African, I think, we went through some pretty dark times a few years ago. I think some signs of light right now. And particularly when I reference the actual energy capabilities of this country, we used to have the most incredibly low energy costs and the most fantastic low risk, high quality energy supply. South Africa has a massive opportunity to play in the downstream processing side with chemical availability, fantastic port infrastructure, energy that could actually be improved. And I think that, it's a shame that with all of these minerals, we're seeing all of these minerals get exported for beneficiation and upgrade in China, whereas South Africa possesses everything to be able to do it in country and actually enable an automaker industry. For example, we have an automaker industry, but it's at risk because it's a combustion engine driven automaker industry, and we should really be producing batteries in this country and manufacturing EVs here. We should be manufacturing industrial goods here. We have everything in South Africa in particular. Other countries also have some of that, but South Africa is really well positioned to be able to unlock the downstream side.
Thank you very much. Appreciate your participation.